Dividend investing is another extremely popular investment strategy. It entails holding the shares of companies that routinely pay dividends to shareholders. But why is this so popular? Let's break it down. When a company is profitable, it essentially has two things it can do with those profits. It can reinvest in itself through expanding operations, or, because shareholders are owners of the company, it can send part of those profits to the owners. When a company is just starting out, it may not yet be profitable. That's the main reason companies seek out financing. They need capital to get going. If the business shows some success, they will grow their operations and revenues. When those revenues outpace their expenses, they are turning a profit. But if a company's management is focused on continuing to grow and become more profitable, they will take those profits and reinvest back in the company to continue their growth. For more established companies that have been profitable for a while, management may decide to return some of those profits to the owners, the stockholders, through regular dividend payments. Sometimes the investors in a company may put pressure on management to do so if the company has been generating large profits but holding large cash balances at the same time. For some investors, a company that pays a regular dividend is a sign of a healthy company to own. They are more mature and may be less volatile than smaller growth-oriented companies. Another reason that dividend-paying companies are popular is that the dividends may make the stock more attractive to investors in general if the share price goes down. Let's explain this with an example. Let's say we have a company that has a share price of $100 per share, and it pays a dividend of $4 per share. That represents a dividend yield of 4%. Calculated simply as the dividend per share divided by the share price. Now, let's say that we hit a bear market. Stock prices are down over 20% generally, and people are selling stocks out of fear and seeking safety for their money. If our sample company's share price has decreased to $80 per share, but the company is still paying its $4 per share dividend, the new dividend yield would be $4 per share divided by the share price of $80, which equals 5%. For people looking for new investment opportunities, that 5% dividend yield could be very attractive to them, and this in turn might attract more buyers to the stock. If the company fundamentals are still healthy, and the company is expected to continue to pay their dividends, this gives investors more confidence in the stock, as the lower the price goes, the higher the dividend yield. Now, it's important to explain the concept of a dividend trap. This is when the price of a stock is down, making the dividend yield very high and very attractive because the company is actually in trouble. If they can't continue to pay their dividend and they reduce it or cut it, investors may then abandon the stock, causing the price to collapse further. So it's important not to pick a stock simply because it has a high dividend yield. You may want to do more investigating. Another reason that dividend investing is so popular is that people just like receiving those dividend payments. Some investors focus on building out their portfolios predominantly with dividend-paying stocks in the hopes of creating a large, regular stream of dividend payments in their account because they prefer receiving regular income. Dividend investors can build out their portfolios with individual stocks, or they can use a variety of funds that have dividend investing mandates. There are many actively managed dividend mutual funds available, and there are even dividend indexes that track the performance of dividend-paying stocks from various markets around the world. Some dividend investors like to hold direct dividend stocks for their domestic holdings and use funds for dividend-style investing in foreign markets.